There will be a time in the future where the fiduciary duty of not owning Bitcoin on your balance sheet will create shareholder litigation. Because once the investor community understands the math, right? Not your opinion, not my opinion, just look at the math. You are not really doing your fiduciary duty if you don't find some way to incorporate Bitcoin into your treasury strategy in some form or fashion, right? That to me is inevitably going to happen.
Welcome to the Bitcoin for Corporations show. I'm joined today by Garrett Johnston from Marsh, a global insurance broker. Really wanted to have you on to talk about Bitcoin and how it fits into the corporate landscape in the year 2025. You have a very unique background. Not a lot of Bitcoiners are necessarily familiar with the world of insurance and then all the specializations within that. But first, I really want to start by your Bitcoin journey and how you eventually got to learn about Bitcoin and become intrigued by it.
Perfect. So I've been in the commercial insurance space for 25 years. I started out in 1999 as an insurance underwriter for a large carrier, and I was in what they called their financial institutions group. And primarily what I underwrote for the first decade of my career was typical TradFi companies. Insurance companies, I would write their own E&O, directors and officers risks, their crime. I would write stock exchanges, banks, investment advisors, etc. And then did that, worked for some insurance brokerages. So in the insurance world, it's kind of akin to when you shop for a mortgage, oftentimes you will use a broker to shop multiple markets and bring you the best mortgage rate. In the commercial insurance world, you typically use a broker who goes to 20 to 40 carriers, gets the best price, negotiates the terms, etc. So that's the world I've lived in. Very corporate, very conservative, being within the insurance space. And then in 2019, 2020 is when I really kind of first discovered Bitcoin. Kind of did the usual where I played around with some of the altcoins the first year, learned a lot, and then kind of got my Bitcoin, not crypto conviction really in 2020. And I decided to stay within insurance because there was a point where I was thinking of getting out, just because as that conviction level built within Bitcoin, I wanted to build there and do something in that space. But I also I just realized how much of a disconnect between the use case of Bitcoin and the insurance industry there is. And so that was 2020, and I've pretty much been focused pretty heavily in that space as far as like, where does insurance and Bitcoin intersect? And things obviously have changed quite a bit with the new administration. We basically went from antagonistic headwinds towards digital assets to tailwinds. And so here we are, we've got all these treasury companies populating. But as we sit here today, there's the kind of Wall Street corporate institutional money that sees all the growth in Bitcoin and digital assets, but really is not connecting the dots on where Bitcoin makes things better. And then we have a ton of very fast-growing, scaling kind of Bitcoin native builders that I'm sitting there kind of cheering on as both an investor and just a Bitcoiner. But there's this massive divide between the institutional space in the insurance side and the builders. And I think the treasury company operations are very interesting because they are outside of MicroStrategy, which obviously is like trailblazed and created a lot of space for these companies to operate. They're kind of the first ones really jumping right into the middle of things, because going public from an insurance standpoint, you go from kind of not having a target on your back to having a pretty big target on your back, a lot of corporate governance expectations and downside risk. So your risk vector landscape just completely kind of mushrooms when you go from the private sector into the public sector. And as Bitcoin kind of bleeds into traditional Wall Street, there's a ton that's traditionally been done from an insurance risk mitigation standpoint that is not understood by the Bitcoin community. And then frankly, the use case for Bitcoin as kind of an arbitrage against inflation and managing risk over long duration is completely missed on the whole by the insurance community. So that's a lot of where I am really trying to spend my time, is being that educator on both sides, bridge builder and dot connector, because that is what is desperately needed, kind of between those two worlds.
So if I'm hearing that right, the two sides are the asset management side of the float, that is all of the assets that are backing the potential future insurance claims, and that there's an opportunity for Bitcoin to help on that side of meeting their mandate. And then the other side is on the insurance side, developing insurance products that are fit for purpose for Bitcoin clients that do need those services. Is that fair to say?
Yeah, yeah. There's a myriad of kind of places to dig into from an insurance standpoint, but yeah, those first two are some of the big ones. So the insurance community does not really appreciate yet what a Bitcoin allocation in any investment portfolio performs over time, right? So, particularly within insurance, you have a whole gamut of products. You have certain things that are short duration. So, again, like an auto accident, you know that you've got to fix your bumper when you get in an auto crash. But like a workers' comp claim, where maybe you've been lifting boxes in a warehouse for 5 years, and there's a lot of this long duration type risk. There's things like reinsurance, there's nat cat, hurricanes, wildfires that have long duration risk. And most of the insurance community, for the most part, they take those premiums in, right? Then they have the float is when you dollar in before you have to pay the dollar out on the claim side. That float, depending on your duration, oftentimes is just invested in cash and cash equivalents, treasuries, et cetera. And as we all know, and Pierre, you do such a good job of kind of like outlining the problems with some of this stuff, is that's a pretty dysfunctional melting ice cube that these big institutional pools of capital like insurance companies have. And how do they harness something like Bitcoin to improve their loss trajectory over time? So again, just theoretically, you put a 5% allocation into Bitcoin. You don't have to uh, go super high conviction, but just do a single digit allocation. And as you model that out over a multi-year duration portfolio, like the loss history just is, it's higher profit, higher performance for the insurance companies, and that helps them manage risk. And frankly, that's good for the consumer too, because at the end of the day, whether you're a corporation or an individual buying your homeowners or auto, prices are, Bitcoin's deflationary on most things, including insurance, if you price it out right and structure it correctly.
Yeah, and on the opposite end, I've heard a lot of complaints that insurance rates have gone up a lot in dollar
Yep.
terms over the past several years. I was recently in Florida, and my Uber driver mentioned that he's going to have to move because he just can't afford the hikes in insurance rates. So it's interesting you mentioned that Bitcoin could potentially help alleviate that rate pressure by having an asset that really performs well.
Yeah. Like another one I was talking about with a guy who's on the policy side last week, is you take California, right? California wildfire risk is difficult, right? So the way this has trended over time, and in Florida, coastal Florida, same way for flood, right? Two different cats, um, same problem. But if you use Florida as just an example, or not Florida, for California wildfire risk, a lot of the carriers have left the state, not because they're unwilling to write in the state of California, but there's a dysfunctional system that they have to operate in that does not allow them ultimately to make a profit. So, you know, oversimplifying it, but when you can boil it down, like you are not allowed, you have to get approval by the state of California on rate increases if you're writing homeowners insurance in the state of California, right? So if you see your portfolio deteriorating because of wildfire risk, you tend to say, hey, you just do the math. And the math will say, I need to increase rates by 15%. Let's just assume that's the case. The regulators might come in and say, that's price gouging. We don't like it. We're only going to allow you to do 5%. Well, you just do the math and you're like, I won't make a profit. And in the, public, this is where we get kind of into directors and officers insurance. At the end of the day, if you're a publicly traded company, which most of these carriers are, when you boil everything down to the baseline, your duty is shareholder value. It's not covering clients, right? Same dysfunction in the healthcare system. But if you can't make your rates profitable, your only option is to exit the state. And so in California, they have the state funded, it's called the FAIR Plan, right? And the irony there is the FAIR Plan, I don't have the number off the top of my head, but it's exceptionally underfunded. And the vast majority of the float that's brought in by the FAIR Plan is cash and cash equivalents, right? So that's a good example of a dysfunctional system where Bitcoin could help fix the California FAIR Plan. It's just one example, right? It's just like very much a vacuum. And there's millions of these use cases across the insurance industry. I wanted to touch on, you had mentioned kind of the carrier product fix within
Oh,
Bitcoin companies,
yeah.
right?
But before we get to that,
Yeah.
I wanted to see on what order of magnitude would you say the total insurance float out there is? Is it in the
Mm.
billions or in the trillions?
I believe it is in the it's in the trillions. It kind of depends if you're looking at like North America versus global, right? When
Right.
you get global, it's in the trillions. So
Yeah.
it's massive. And a lot of the insurance capacity is global capacity, whether they're domiciled in Europe like an Allianz or they're domiciled in the US like an AIG or a Chubb. They all write global risks out there. But it's a massive amount, right? And so it's there's just a huge opportunity over time for Bitcoin to kind of solve some of these kind of just pernicious inflation issues, because carriers are getting hit with the same inflation issues of, it costs a lot more to get back surgery these days than it did. And that's ultimately underlied in inflation. There's inflation in just getting your car fixed, right? There's inflation is kind of all over the place. And then particularly when you look at, the broken fiat system, it's just rife with issues, right? So one of the dysfunctions out there in the US is not only do you have top line nominal inflation, but you have what's kind of referred to as social inflation in the industry. And that is where jury verdicts on claims that go to jury trial are getting really dislocated from reality. So you also have litigation funding. So hedge funds are starting to fund some of these claims because they're taking a cut of the jury verdict. So it's just a good example of a broken system. Perverse incentive structures create perverse outcomes, not for the betterment of society. It kind of just works against everybody. It works against the carriers, ultimately works against the clients at the end of the day. And that's where there's a lot of opportunity to do better.
Wish you could access cash without selling your Bitcoin? Ledn is the global leader in Bitcoin-backed lending. They've issued over $9 billion in loans since 2018 and never lost a single Satoshi of client assets. A Ledn loan is different. With custodied loans, collateral is not lent out to generate interest. No credit checks, funds in under 12 hours, with proof of reserves reports published every 6 months. Ledn gives Bitcoin holders a secure and transparent way to unlock liquidity without selling. Learn more at ledn.io.
Yeah, and it's really sad because I think that there's this mentality that's taken hold of, oh well, if it's the insurance company paying for something, then it doesn't
Yep.
matter what it costs. And they kind of gloss over the fact that that gets passed along in rates or in
Yep.
availability. It's not like a free lunch.
Yeah, we refer to that in the industry as moral hazard. So, hey, I've got insurance, I'm not going to drive as careful. Or I've got insurance, so what if they sue me, right? If you're running a business, right? And to your point, that's exactly how it is. Insurance companies, ultimately, they want to make a fair return on investment. Usually it's, 10 to 15%, and their shareholders are happy. But kind of to that California example, if you can't make a profit, like you've got to deploy your capital elsewhere, because you're essentially looking for yield on the premiums and the risk you deploy. So um, it's a problem when it snowballs, and it does come back to you, right? So you do want to be a good corporate citizen ultimately, and that's part of a lot of what I spend my time in is how do I help companies navigate their corporate governance. So particularly like all these companies with reverse mergers, the Bitcoin Treasury companies, um, they're getting into territory where the corporate governance and compliance really matters at this point. And if you don't pay attention to it, you could easily face a shareholder claim. And like MicroStrategy got sued recently, right? Shareholder claim. And like, if you actually read through that one, that's just a good example of like, you don't have to be wrong. You can be sued and it's going to take you several $1,000,000 just to deal with that claim in legal fees, right? Because like as a Bitcoiner, when I look at some of the reasons for the complaint, they're kind of silly, right? Particularly when we're looking ahead of what like likely the Q2 revenue is going to look like coming out of that exact same company, right? But that's the reality you live in. Like, oftentimes you get sued on allegations, whether there's much truth to them, you got to deal with them. And they're in the public company setting, like it takes you $5-10 million just to deal and get a motion to dismiss. Like it is not. And there's inflation pressure on the legal fees too. So when I started in the business, ridiculously high white glove legal fees were like $500 an hour. Then it jumped. There was a point in time where we were like, I cannot believe these firms are charging $1,000 an hour. We're well past $2,000 an hour now.
Wow.
So it's like you see inflation all over the place. And at the end of the day, the carriers have to fund for that risk. And so that's where rates are just a derivative of, insurance is in some ways a derivative mirror of the litigation environment out there. Property cat loss is going to be more the environmental aspects. But when you get into D&O litigation, suits against the board of directors for mismanagement, that really is just it's a function of the litigation landscape.
Yeah, so it's really interesting that you bring up the governance aspect of it, because this is I think a conversation that has been going on online, is concerns about the Bitcoin treasury companies and corporate adoption of Bitcoin as being comparable to past manias in the crypto world. So people will
Yeah.
point to ICOs, or they'll point to FTX, the offshore exchange, and they'll compare that to a publicly traded company where my background of accounting and public accounting, and having worked at Deloitte, and kind of seen the inside on the TradFi system, uh, and working on internal controls specifically as well.
Yeah.
I have this gut reaction of, what an absurd comparison, because
Yeah.
a lot of the critique of ICOs and of FTX was the lack of governance, the lack of risk management, the lack of audits, and all of these good corporate practices. And that what you're describing, it's almost the opposite, where they're under too much scrutiny, in the sense that it's unfair, unwarranted scrutiny of a frivolous lawsuit, right? And so it's fascinating to see kind of the difference between the narratives that some might have about that this is some kind of uncontrolled mania comparable to
Yeah.
ICOs, where there was no accountability, and those management teams did squander the funds that they raised, and that the SEC, had to crack down on that.
Yeah, it is a fascinating dichotomy, and it's very illustrative of the knowledge gap that's out there. So in my day job, dealing with insurance carriers, helping Bitcoin denominated or Bitcoin kind of adjacent companies get insurance, like it is very common for me to have, for a given risk in a normal non-Bitcoin denominated peer, I might have 40 markets that I can arbitrage against each other, get the best terms, say, hey, do this because your competitors are going to do it and you're not going to get the deal. If you don't, get the pricing down. As soon as you mention, I'll say digital assets on a whole. Because Bitcoin, like from an insurance standpoint, I'm very much a Bitcoiner, but in the corporate insurance world, Bitcoin is just considered a digital asset. It's just considered the biggest one, but there's very little distinction between Bitcoin and all the other cryptos. So I still very much deal with, well, how do I know Bitcoin's not going to be the next FTX, right?
Right.
And the irony to me is I was an underwriter that would insure exchanges like traditional FTXs. So like whether it was like an E-Trade or a Schwab or Fidelity, something like that, those were the clients I would insure in my early days. And to your point, it was all about audit controls, controls and procedures, all that kind of stuff. And FTX, I kind of always joke, like FTX was 1980s fraud. It had nothing to do with the tech. What he arbitraged was the lack of regulatory framework around it. But he rehypothecated and he embezzled. That does not take the technology. He just exploited the regulatory framework, in my mind, on that whole fiasco. So we're still dealing with the residue of that. And I still deal with the ESG FUD on Bitcoin miners, right? So like, I love the, you've got such a great piece you did a few years ago when you're at Riot with your CO2 monitor going around and completely just debunking the whole, greenhouse gas FUD that was really rampant at the time out there in the industry. So we're still dealing with that today. And I think, the insurance community is usually the one left holding the bag on a lot of these things. So like the insurance community is still paying out on some of these, FTX era fiascos. They have long memories, and there's just kind of some residue within there where they still think Bitcoin is going to be, it's just going to be the next FTX. It's going to be a different flavor. Right. And then we kind of get into, like a MicroStrategy play. I completely agree with you. That is, there's all this FUD around they're taking on debt. It's going to be callable. There's liquidation risk. There's a complete lack of understanding of the flexibility that Saylor's built into his particular converts and then all these preferred shares. I look at that and I'm like, once you kind of dig in and see his optionality, and particularly with these ATM things, like he is a completely different risk than your traditional raising debt, TradFi debt raising scenario. But that is just very underappreciated. And so where I play at that intersection is, if it's not appreciated, it is misunderstood, and misunderstanding often leads in lawsuits, right? MicroStrategy, their lawsuit is, to me, a big misunderstanding of what I feel he's been pretty abundantly clear on his strategy. Like in the D&O world, so directors and officers, that's when you get sued for alleged mismanagement. When you're public, it's usually some derivative of like a Monday morning quarterbacking of, hey, you should have disclosed this and you didn't, right? You said you were going to do this, yet the results were this, which is kind of what the essence of that recent lawsuit is. And it just shows a lack of understanding. But at the end of the day, there's a plaintiff firm that's bringing it. They're going to get paid a decent amount of money, and that's part of the perverse system that they're in. And that to me is what I spend a lot of time guiding the builders, whether it's the Bitcoin Treasury companies or the smaller companies, of like, okay, you're growing great. We're in this kind of hyper Bitcoinization. We have a lot of top-down support from the government now. You're getting into new territory. There's a whole new risk landscape that opens up that you need to be prepared for, and use some of those lessons from the TradFi insurance space. Because, I get to see all the dirty laundry of these companies, as do the carriers, when stuff hits the fan, right? And everybody's moved on from FTX. We're still seeing some of the fallout from some of those spaces.
So mechanically, what is that D&O insurance, and how does it work in a situation like this?
Yeah, so directors and officers insurance, it's usually structured in kind of a 3-pillar format of the coverage. We refer to in the industry as side A, side B, and side C. I'll kind of go backwards because I think it's easier to articulate that way. You have individuals, the individual directors, and you have the company, right? So you have balance sheet exposure and you have individual exposure. So a directors and officers policy will cover the balance sheet of the company. So it's going to cover the company as an entity, because in legal terms, the entity is a person in law. And then it's also going to cover, that's the side C cover. Then you get over into side B and A. B is covering the individual directors and officers when they are indemnified by the company. And most companies in bylaws say they'll fully indemnify you to the extent allowable by law, right? If you knowingly do fraud and are criminal acts, and you can't indemnify for that. Then you get to side A. Side A is what we call non-indemnifiable insurance. So that is when either they can't indemnify you, won't indemnify you, which again, won't is usually pretty rare unless there's criminal, knowing fraud. The won't part is usually a solvency issue. So even though you could get covered by the balance sheet, they're bankrupt or they're insolvent. So the D&O is really, really important to the directors and officers of the company because in many ways, it acts as the financial backstop for the individual directors. I mean, it is the thing that ultimately helps them pay their legal fees when the company blows up and goes bankrupt. And it also stands in and it softens some of those legal fees down the road. So
And
it's a really
is that
important cover for public companies in particular.
is it purely about civil litigation from shareholders?
It depends on where you are in your cycle. So in the private company space, oftentimes the entity cover covers the entity for a whole host of issues. Typically, it could be private shareholders, so it could be VC backers, it could be anti-competitive, like antitrust issues. When you get into the public space, typically the coverage for the entity gets isolated solely to shareholder claims, which that's where 9/10 of your exposure is. So that's always something in insurance that is not well understood. It's partly why I think oftentimes people are a little too binary when they think about these things. So I have insurance, I'm covered. And then they're frustrated when it's not covered, right? And the reality is insurance is a tool, it's not a solution. So it's a way to cover off some things, but they're not going to cover others. And over time and with case law, if carriers cannot underwrite and kind of encapsulate the risk and price for it, they'll exclude it, right? So like, I'll give you a good example of one of the ways they'll either exclude it or they'll sublimit it heavily. So a sublimit is simply if you buy a $10 million policy, they might have a sublimit for $1 million for a piece of the risk that is really difficult for them to wrap their arms around. So in the kind of crime cyberspace, this coverage of social engineering is an example that's often. So those are phishing attacks. Those are any kind of clickbait type of scenarios that try to get you to transfer funds in a fraudulent way. Very, very, very difficult to underwrite around and very difficult to insure. So they supplement that pretty heavily in this space. So that's an example of, can you find the coverage out there? Yes. Is it going to be supplemented? Yes. Could you theoretically buy a lot more insurance for it? You could, but it's usually cost prohibitive. Punitive damages is another one, depending on the policy, depending on the jurisdiction. Some jurisdictions don't allow you to insure for punitive damages. And then there's a whole host of ways to do insurance products around that. You can do offshore puny wraps outside of the United States as one example, but insurance has got a whole plethora of ways you can deal with risk. But as I always tell clients, like risk comes for you whether you insure it or not. It's a trade-off you have to make. And just because insurance is available doesn't mean it's economically viable. And just because you can purchase insurance doesn't mean you necessarily should. You've got to think through the pros, cons, trade-offs in that scenario. Bitcoin custody insurance is a very similar space where the amount of, a lot of these custody firms like to say, yeah, we have insurance, right? Yes, they do. But the insurance is very specific, very narrow for certain vectors. And I think there's a pretty big underappreciation of what's not actually covered in those insurance policies for the most part.
And does the pricing change a lot based on the riskiness of the industry, right? So if they
Yeah.
might look at, for example, covering Boeing, where they might have an airplane accident that would lead to shareholder litigation, would be different than something more plain vanilla.
Yes. In a lot of that, it's kind of orders of magnitude. So at the highest level, insurers want regulatory stability and they want structure because at the end of the day, as I grew up as an underwriter early days, so like my job was to meet a bank, interview their CFO and their kind of controllers and go through all, and my job was to, how broad am I going to make the coverage? and how much am I going to charge them? And my job was, if I charge you $100,000 5 years in a row, I better have whatever I charged you minus claims should be less, right? That'd be our combined ratio. So a combined ratio of 100 means for every dollar you bring in, you're paying out on the back end in claims. So you want your combined ratio to be, 90%, 85%. So you're making margin of what you do. That ultimately is the game of underwriting. So that's the challenge that all these companies have. If you don't have a structured regulatory environment, how are you going to price your risk, right? It's akin to, like, in fiat world, like for us Bitcoiners, how are you going to value risk in US dollars when the Fed like this can just debase the currency overnight, right?
Right.
The short answer is you can't, right? And that's where Bitcoin fixes it, where, and again, lost on the insurance community as a whole right now, they're sitting there in this broken fiat system where they're trying to wrestle with inflation, yet they're kind of ignoring on the one end, as of most non-Bitcoiners are, that this inflation dynamic of printing of money at will is creating all the downside problems, right? So you do something in a Bitcoin framework, to Jeff Booth's points, like everything goes deflationary at that point, right? But we've not had the regulatory framework. I mean, if anything, we've had an antagonistic framework all over the map until the new administration. So I think the best thing that the administration does is just, they've simply said, we're going to try to get this right. And, no administration with their best effort is going to get it perfect. But the fact that we're even in an environment where it's not just Trump, but all of his cabinet are basically committed to putting a digital asset framework, that will set the stage for insurance capital to come in. Because for a lot of the Bitcoin native companies, the custody firms right now, 99% of the insurance capacity doesn't sit in the US. It's Lloyd's of London, it's Bermuda, it's other offshore jurisdictions that are just a little bit more flexible. And we really need to get to a point where the large European and US denominated insurance companies jump in. That will really bring price pressure down. But you have to have regulatory framework first before we get there. So that's where the market structure, the bill, stuff that Senator Lummis is doing, those are part of the arc that are in the important groundwork cornerstones that need to be done before I think, the standard market, participants will really come in at scale. So we're still, it's a long journey that we're on, but we're kind of in the best position we've ever been because we have buy-in on Capitol Hill for the first time. So that to me is really important. And it's why I think we're seeing such a kind of, this kind of pent-up demand. As soon as the new administration came in, we've seen all this growth in digital assets, right? BTC Treasury companies being just a perfect example of now's the time for that kind of dynamic to take place.
And the BlackRock ETF as well, getting approved last year, I think on the institutional side was hugely validating. But do you think that it's a challenge for companies wanting to adopt Bitcoin on their balance sheet, having concerns about the risk of shareholder litigation and the impact on their D&O insurance?
Yeah, it's tough because it really is about kind of the investment relations side of things. And I think Daniel Batten did a post that I thought was very appropriate for what I see in the space. And he was kind of talking about Meta's latest, shoot down of their Bitcoin Treasury proposal within their shareholder meeting. And he kind of made the argument that it's the same institutional shareholder base that shot down Microsoft and some of the others because they're just not quite there yet, right? So I think there's a difference when, Saylor in many ways in MicroStrategy, he had the luxury of being, he holds such a large proportion of the company, and he did the work at the board level of forcing them to read the Bitcoin Standard and do the homework where they got it. because you have to have conviction across the company. And I think it was really important how he did the Dutch auction opportunity for when he made the announcement of, hey, if you're not on board with this shareholder, I'm going to give you a premium to get out because here's where we're going, but I'm going to give you a nice kind of friendly exit ramp. I think, there's a different case to be made for like the Strives, the 21s, the Nakamotos, where out of the gate, they're saying we are Bitcoin only. That's a different world because they're going to attract the investors that are already on board with that strategy. Where I think it gets tougher is, like a Semler or a Cooler or some of these, companies that are traditional operating kind of were zombie companies that have taken a Bitcoin treasury strategy, but they're not, even though there's a good amount of conviction at maybe the CEO level, they're not going like that full-blown all-in pivot like MicroStrategy is. So I think there's risk factors there of there's still an operating business that's not a Bitcoin treasury company. And there's still shareholders that are maybe not quite appreciating the Bitcoin treasury strategy, right? So I think that's going to be an evolving space. But again, to me, from an insurance standpoint, when shareholders don't understand the business or they don't like the way the stock price is going because they don't understand what the longer term vision is, and maybe they're looking at it quarter to quarter, that's just an ecosystem for shareholder litigation. So I completely applaud those companies that are taking a Bitcoin's treasury strategy. They are like historical operating business. I think that's a good thing. So like over the long arc, over the next few years, D&O insurance ultimately insures companies for an alleged or actual breach of fiduciary duty, right? And when you boil everything down, the fiduciary duty of anybody at a public company is to increase shareholder value, right? So we're in this interesting time where a company that is non-Bitcoin treasury strategy could take on a Bitcoin treasury strategy. And the FUD out there might be like, hey, you're not doing your fiduciary duty. Bitcoin's too risky. When those of us that have done the work and the homework on it actually realize that's better for the company. So it is only a matter of time. It may be 5 years from now, maybe 10 years from now, but there will be a time in the future where the fiduciary duty of not owning Bitcoin on your balance sheet will create shareholder litigation. Because once the investor community understands the math, right? Not your opinion, not my opinion, just look at the math. You are not really doing your fiduciary duty if you don't find some way to incorporate Bitcoin into your treasury strategy in some form or fashion, right? I think we're a long way off from that. But that to me is inevitably going to happen. It'll just take time. And I think these Bitcoin treasury strategies are going to shine a really heavy light on demonstrating why, right?
Yeah. So on that, it seems like a big important piece of Saylor's role at strategy, even Dylan LeClaire at
Yep.
MetaPlanet, is being able to explain the why of what they're doing and why it creates shareholder value. Um, and then when I go back to hearing perhaps more traditional earnings calls with CEOs where it's very dry and it seems like it was written by their attorneys
Yep.
and their communications director and maybe even their insurance broker,
Yep.
do you think that there are risks with how much communication that Bitcoin treasury companies are putting out there and how to mitigate those so that
Yep.
they don't turn into litigation?
What I think there's going to be short-term issues with long-term gain. So historically, yes, you're usually very scripted. If you run the risk, usually the lawyers are going to tell you as a board member, like if you don't, what you say will and can and will be used against you, right? So they usually coach board members, executives to be very scripted, keep everything within kind of the four corners of your SEC filings and just don't go off script, right? I don't think you could actually function well with what you take Saylor, right, who's kind of the trailblazer here. There's no way he would have been able to effectively communicate why he's doing what he's doing without like the constant drip of, here's my conviction, here's why. Let me explain why we're doing what we're doing. So I see a world where, I think Dylan does a great job as well. When you take kind of the Bitcoin ecosystem, particularly, led by really MicroStrategy early on, I think Metaplanet does a really good job as well. And then all these treasury companies, it's a totally different communication game that they're in, which I don't honestly know how this will play out, because I can see a very fair argument that there is so much communication that gets thrown out there on social media, these podcasts, etc., that there's an argument you are setting yourself up for, well, you said this and therefore it didn't play out this way, so I'm going to sue you. I think my personal view on that is I think that is going to be something that will happen over time, but I think that will fade over time, because I think, as a shareholder, I really, really appreciate the communication, because I bought into strategy in 2022. I love the amount of communication I get, and the amount of communication I get like makes me a more stable shareholder, because I really understand the why behind what they're doing. That being said, I'm not sure everybody does, right? So my view is I do think that is the better way to go. And we've seen this play out politically. Like, whatever your political leanings are, the right played the long form podcast angle way better than the left did. And I think there's a level of disclosure and authenticity that comes with these long form podcasts. I see it in insurance too. So, like, to give an example, like, insurance is 99% on LinkedIn. Very, very few of them even touch X, right? And so you go into the Bitcoin land, it's almost inverse, right? Zero people post from X onto LinkedIn because they feel they have to, but they don't really have any activity other than X. So I kind of sit in both of those worlds, and it's so eye-opening to me how careful and calculated the LinkedIn posts are, and how just speak your mind attitude there is on X, right? From a corporate governance standpoint, like, there's an argument to say that's a dangerous game to play. But I think that actually is, I'm a fan of that. I think that is what more companies need to do over time. But if I'm being honest, that's riddled with lawsuits, right? That disclosure will come with lawsuits. So that's part of where my passion as a Bitcoiner in insurance kind of lies, of like, I think the amount of disclosure that they give, like I can go on my MicroStrategy app on my phone, and I think all their metrics, all of them are updated every 15 seconds. I love that, right?
Yeah.
And you look at their shareholder calls, and I think they had 150,000 people on the live stream for their shareholder call. Like, show me a buttoned up traditional, quarterly earnings call that has anywhere close to that kind of engagement, right? So I think we're just in this transitionary time where, whether it's social media, like, I think just the governance rules are slowly shifting, and there's a bit of a generational divide. So I'm in my late 40s, so I kind of feel like I always fall in between those two buckets of, I have a lot of clients that are a lot younger than me, and I have a lot of people in the insurance community that are signing off on managing these pools of risk that are older than me, right? And this will kind of come with time and iterations, but that's, again, I kind of sit in an interesting chair from a career standpoint, but I also sit at an interesting age where I kind of fall between, I'm old, but not too old quite yet. So.
Yeah. I'm reminded of the Financial Times. They ran a 20-minute hit piece on MicroStrategy recently,
Yes.
comparing the scarcity of Bitcoin to teeth. A point that the journalist made that I thought was really interesting was that one of the arbitrages here on the information landscape is that somebody who is representing a Bitcoin treasury company can speak pretty freely about Bitcoin as a commodity,
Yes.
and they're not necessarily promoting their stock, they're promoting Bitcoin. But then, the inference is left to the viewer of, oh, well, that company holds a lot of Bitcoin. So, it's um, that they would not be able to speak so glowingly of their shares, right? Of
Yeah.
the common stock, without really tripping some wires over at the SEC.
Yeah, and I think it's just an example of like there's like infrastructure that's been created over, many, many decades with case law. And then you have these transformative businesses that frankly kind of like, like they're all playing by a different game. They're totally within the
Yeah.
bounds of the law, but like they're thinking about their financial metrics in a totally different way. So like when somebody who's not kind of gotten themselves educated on Bitcoin and like in the why behind it, you would sit in on any of these calls of these Bitcoins and like Bitcoin yield and all the MNAV and all this stuff. Like they're just like I don't even know where to start as far as like if that makes sense to them or not. And like as a Bitcoiner, I'm like, man, I love those metrics because those make a ton of sense to me. And so yeah, it's just um that's on the good side. That's actually like an arbitrage to the good, where I think Bitcoin treasury companies do have a little more freedom. To your point, like you talk about Bitcoin, you don't talk about your company per se. Um, but it does give you more communication avenues that, uh, yeah, I mean, there's a reason Saylor doesn't talk about his stock because there is case law and there are certain like bounds he just can't cross over without getting into more trouble than it's worth from a litigation standpoint. So I look at that as like a kind of put it in the feature, not a bug part of Bitcoin.
Right.
Um,
Yeah.
it'll be interesting to see if these market structure bills, Genius Act, like if some of these things start to put a little bit more parameters around discussions around commodities versus stocks. I've not necessarily seen that, but who knows how that'll play out. But I it's part of the space I really, really like. It's just how freely they talk.
It's fascinating, and even when I worked at Wright, you mentioned the video we did about the carbon emissions. Um, it was not like something that was advised to us by a communications or a public relations firm to do that. It was very much improv of, oh, here's how
Yeah,
we'll hit back at the New York Times, and by going direct in that manner, we ratioed the New York Times on X, and so our messaging got out there that um, if you think carbon emissions are a problem, that problem is coming from the power plant. It's not coming from the end users of the electricity,
right.
which is very important to establish, where that liability lies. Um,
Yep.
and that we got lots of great feedback from shareholders saying, hey, we're really happy that y'all are tackling this issue head on and not trying to hide from it or to pour money into it that is uneconomical, right? That
Yep.
would be wasteful to try to do some really inauthentic PR campaign against it or something.
Yeah, I think it's really important, and I think it's where just the media landscape and the PR landscape is intersecting with kind of investor relations, because yeah, you never would have done that in the past, right? And the fact that you can on a whim basically grab your CO2 thing, record like a 5-minute video, post it on X, and ratio the New York Times. We're in a different world as far as investor communication. Um, I'll give a shout out to Jack Mallers. Like I thought he did a fantastic job recently where they got into the lending space and somebody called him out, rightly so, on the rehypothecation language within the lending that went against a statement he had made. And in a normal world, the insurance brokers, the lawyers, we'd all be freaking out like, Jack, shut up. Okay, we're going to lock you down. You can't go on X. We're going to put this PR firm in place. And he just literally just gets on X and just owns it and fixes it. And when I think of like a corporate governance model of leadership, like that was phenomenal. Like as a D&O underwriter, former D&O, I'm like, he just nipped a lot of liability in the bud, right? In my mind, right? So
Yeah.
I think there are dangers to communicating constantly, but I think what I really appreciate and love and gives me confidence in the Bitcoin space, not the crypto space, to be frank, is the level of conviction at the Bitcoiner level. And again, like Jack's just a good little illustration. So is Saylor, right? The command that they have of their product and the why, they don't have to go scripted. They literally speak from their heart. They speak off the top of their head. Like, like Saylor's thing with Peterson that he just did was like, same thing. Like very few CEOs or chairmen are going to do that because they're too afraid of saying something. But if you've done the proof of work, right, and you understand Bitcoin, you're kind of like, that the truth will kind of land on your side, even if you're misunderstood. And I think that's the chapter we're in kind of this corporate governance game. Like it's gonna be messy. It just is. Like as when the institutionals and retail investors don't understand Bitcoin, there's gonna be lawsuits, right? So that's a lot of my day job is like as a Bitcoiner, like I want nothing more than these BTC Treasury strategies to succeed. But it's also I'm like, I've been doing this for 25 years. I've seen all the bad stuff. Like, let me help you just stay out of the woods, and let me also like help you like figure out where Bitcoin mitigates. Like maybe you don't need to buy insurance on this thing because the Bitcoin technology mitigates some of the threat vectors. So like I have a lot of those discussions of the intersection, particularly in the custody world right now, of the programmability of Bitcoin, whether it's like mini scripts, time locks, some of the stuff that Adam Beck is doing on his side. There are ways that kind of going back to your auditing days, like we would look at like compliance, audit, what's your audit cadence? Like, what does that all look like? There's a lot of things that cryptographically you can just do better that a custody crime underwriter at like a Lloyd's or one of the big markets, they don't fully appreciate yet that, because an underwriter is going to be like, let me look at your audit procedures. Like, how can an employee steal from the fund? How can an outside attacker come in and steal funds? You didn't have cryptographic, ways to mitigate some of those things like you do now within the Bitcoin ecosystem. So that's just another like example of, I spend a good amount of time with companies of like, I'm an insurance guy, I'm not a technologist, right? So I have to brush up on the technology level and lean on my clients in many ways of, so teach me how this works. And then I put my underwriting hat on thinking, okay, that tech just solved one of these things I would normally put down as like either a red flag, I'm going to charge you more, or a green flag, I'm going to give you a credit because you did good, you did bad, right? So we're at such early days in that space that the insurance industry, I think, just has a lot of opportunity to improve the overlay of the tech and the insurance product and capacity on top of it.
That makes a lot of sense. And so for those going on this Bitcoin for corporations path, what are some pieces of advice you would have for them, as they go on their journey?
Yeah, I think it's just get good people wrapped around you. Like I think I think the biggest fault you can have is my banker's my banker, my lawyer's my lawyer. They're old school, they're TradFi, they don't get it. Bitcoin's totally different. There's truth to that statement, right? But find people within the legal community that actually understand Bitcoin and then lean on their kind of traditional, they have a lot of learnings to give you, particularly as you're scaling. And then work with them of, okay, here's the risk vectors. Here's where I think Bitcoin is different, and like challenge each other and like have that vetting process of sharpening each other up. Do that with your auditing firms. Do that with your insurance broker. Because there's a lot of, when I'm sitting in the room with like Bitcoin companies, they'll say something. I'm like, there's an insurance product that can fix that. It may not be perfect, but if we tweak it a few ways, we can offload that risk at a fraction of the cost of whatever they're wrestling with, that they often don't know of. And sometimes I'll say, I think your exposure is here. And they're like, well, let me tell you why that doesn't exist because of the tech. Fair point. And so if that's, that partnership, I think is the real key thing to walk away with. Get really good firms around you, firms that have a broad scale of, because I will talk to Bitcoin Treasury companies on how do you vet your custodians, and I'll talk to custodians, how do you make a better product to attract more Bitcoin Treasury companies or institutional capital, right? So I get to see both sides of the table, and a lot of my jobs is like, okay, if you want to go from here to here, insurance can get you this way, but if you need a lawyer, if you need an accountant, most of us are fairly networked, and there are, there's only a handful of insurance professionals that kind of get digital assets. There's a handful of lawyers. There's a handful of accountants. There's just not many of us yet. So that's another call. Like if you are in any of those spaces, I am big on the network, because as an insurance person, I'm often asked, do you know a good lawyer that understands digital assets? Do you know a good accounting firm? Like, it's not just, Deloitte, but who at Deloitte or who at KPMG, right? Those types of things. So there's a lot of value that your service provider in that kind of professional services space can add to you beyond just, please get my insurance done, please get my taxes done, et cetera, et cetera. So
that makes a lot of sense.
yep.
And then last question before we wrap up is, a lot of these treasury companies seem to be going international or are
Yep.
international. What are some like the unique challenges there with insurance and D&O in particular?
Yeah, if we go back to D&O, it's jurisdiction by jurisdiction. So most policies, if you get a D&O policy, they're usually for an American-based company, the coverage will be worldwide. So you don't have an issue of like, it covers every country outside of like OFAC sanctioned countries. But there's all these, when you get in country by country, certain countries will allow a US-based or a Lloyd's-based policy to be called admitted. Other countries will say, we don't accept that policy. So you have to have, in addition to your global policy, we're going to have you buy a local admitted policy from a local insurer in Venezuela, or you name it. So when companies go global, you can't just rely on your global, just because you have a global D&O policy does not mean it's going to be accepted in XYZ country. So it's a complete hodgepodge of regulatory frameworks. That's where like having a global broker such as Marsh, where I work, is important, because we have offices in 130 countries. So we have people in-house on the ground that, one, they speak the local language, they know the local authorities, the legal system, etc. Because if you don't do it, what you can run into is you could have a director, an in-country director, that gets sued. You want to pay them, but the country, like, you want to indemnify them for their legal fees, but you're not allowed to by the country because you didn't buy a local admitted policy, or you're allowed to, and then you get hit with a bunch of fines. So it's a compliance and it's a governance. And as soon as you go outside the US, it is just a complete matrix of, do I not? Do I need to? So that's really where you want to lean on your insurance broker from that standpoint. This seems to go international.
Well, this has been a really fascinating conversation, Garrett. Thank you so much for coming on. I think that hopefully we address a lot of the questions of either companies that are looking to acquire Bitcoin or already have and are
Yep.
grappling with all these different big questions in the space. So thank
Yep.
you for coming on, and we'll hope to have you back on soon.
Sounds good. Thanks, Pierre.